Okay, thanks everybody for braving being here on this sort of balmy day. I live in Montreal, so this is pretty normal for me, and actually I can't understand why the whole of London seems to sort of come to a standstill, but still. This session is more about applying what the previous panel talked about, the global economy. What does this mean for asset allocation? What does this mean for portfolio construction? We have with us today four very distinguished speakers. If I can just ask them to raise their hand, but there's no name tags here when I sort of call them. Michael Howell, Tim Hayes, Gulav Salia, and by Eric Britton. So the panel today, I hope, will be reasonably free flow. There'll be plenty of opportunity for questions. I would just encourage you to disagree and don't feel afraid to sort of ask pointed questions. I think all of these gentlemen are very experienced in answering questions of all descriptions. And by definition, since they are global strategists, they can talk about anything, right? There's nothing which is beyond their remit of expertise. But I thought by way of introduction, there are a couple of things which we probably need to consider in terms of where we are now. If I was to summarize the last panel, it would be the global economy is great, but things can't continue at this pace. The rate of change is probably going to diminish even if we don't go into a material slowdown in economic activity, and having equity markets and asset prices and generally discounted that. But I think there are more refined issues also to talk about. I mean, the first thing is, are we in a bubble? Equities and bonds, if you believe Mr. Greenspan, clearly we are. What does interest rate normalization mean for the asset class choice? And that obviously entails some sort of expectation about the way the Treasury market's going to behave in the United States, and whether kind of in an interest rate normalization period, having had 18 months where the global economy appears to have normalized, will equity markets actually be able to withstand that? And what is the key trigger point? Is it 3%, as a lot of people were talking about 12 months ago? And now the new consensus seems to be, no, it's not going to be 3%, it's going to be 4.5%. It's probably a finger in the air type of calculation, but nevertheless, it's worth thinking about. And then something which I think is probably should be talked about, but is not being talked about. Everybody's mesmerized by what's going on in terms of the Fed. Given the political developments we've had in China over the last couple of weeks or so, where we seem to have potentially a president for life in true African type of traditions, will China's mini upswing continue? It was obviously driven by a very powerful fiscal impulse, and that fiscal impulse seems to be fading somewhat. So what's going on there? Will inflation rise? And if so, is this the time to start accumulating hard assets? Is another question to ask. There seemed to be some sort of consensus that inflation was heading up, at least cyclically, over the next 12 to 18 months. Obviously, the secular headwinds are still extremely strong, both in terms of technology labor, sort of substitution effect, in terms of people buying more and more things over the internet, and therefore the only global output gap which really matters is the global output gap. I mean, how is that going to impact on inflation? Is it going to put a clear cap on it in the short term? And even if it doesn't, is this the time to start accumulating hard assets? What is the outlook for gold? What is the outlook for assets generally? And then there's this old thing in asset allocation that sort of one period's winner tends to be the next period's loser. Markets tend to naturally overshoot, irrational exuberance, etc. And then the following year there is some sort of corrective period. Europe obviously had a miserable start to the year, and the question on the relative basis at least, and the question is, will it enjoy another year of outperformance? And then the final question, I guess, as I go around and I talk to people, is this: are we all overconfident? You know, it seems to be an environment altogether now buy on dips. That type of learned behavior hasn't really fundamentally changed. I think most people, and the consensus out there seems to be that we are in some sort of bubble for equities and bonds, but everybody thinks they can jump off the train just before it hits the buffers. So we may have enjoyed some sort of major structural change in the global economy, but human behavior remains constant. The most dangerous words in investment, need I remind you, it's different this time. It clearly isn't. So those are a couple of issues which I think the panel can get involved in. So I'd just like to sort of start off by sort of asking, taking off where the previous panel sort of left off, and that is, okay, the global economy is in rude shape. Everything seems to be reasonably hunky-dory. We're obviously going to have a major fiscal impulse coming through in the United States, which should push US growth along. But are we in the bubble in terms of financial assets? So, Tim, I'll start with you.
I would say we certainly would consider this a bubble in terms of bonds, in that we've reached the end of a 40-year secular bull market where I think really what it gets down to is just the lack of concern about inflation is sort of the sign of a secular extreme sentiment. So I would say in bonds, and that really has been the question, which maybe we're seeing this year, is when will yields finally break out and move into a sustainable up move. We've described this as a reflationary phase that ultimately will move increasingly toward inflation. So as inflation expectations gradually pick up, and to your point about a global output gap, I think that is a key point, is that as much focus as there is on the US, we're still seeing very depressed yields globally. So it's going to take time for this to happen. So far it hasn't. Maybe this year it will. But I'd say bonds certainly are at a secular stream. Equities, however, it's more of a cyclical risk. One of the themes we've talked about coming into this year was that we would see that after this unusual year last year where the biggest correction was less than 3%, the record number of record highs in the market where things were so calm, we would see a return to volatility, return to normal in terms of corrections. And this is sort of what we saw similarly in 2015, volatility picked up before we got into actually a more fundamentally driven decline in 2015, 2016. So that could be what we see this year as a return to normal. As we hear the term normalization that applies to many things, including the performance of the market. And corrections, we'll start to see what we just saw will start to become more normal, and therefore the sort of buy the dips mentality, as you mentioned, may start to diminish, and perhaps the bigger risk will be next year when the fundamental drivers send us into some kind of cyclical bear market. But to summarize, I would say bonds, secular risk, equities, cyclical risk, but probably okay for right now.
And just to pick you up quickly on the question about inflation, inflation expectations might be picking up, but if you look at the fusion indicator, the rise in inflation has A, been particularly narrowly based, and B, if you actually look at the rise in wage rates, which clearly you would expect given we're operating below the natural rate of unemployment, but if you look at unit wage costs have actually been particularly well contained. Is there a chance we get kind of some sort of productivity boost over the next 12 months, particularly as a masked effect of the fiscal stimulus?
Yeah, I mean, actually, that's a key point. Is we don't want to jump ahead here on bonds. We had a similar situation back in the 50s and going into as we got closer to the 60s, where it takes a very long time for yields to kind of form this long-term bottom. So, yeah, I think the fact is that we do have still a lot of slack in the global economy, and we have the chance of some more depressing impacts on inflation globally. So, maybe yields will be, this could be the big surprise this year, is that yields maybe have these sort of head fakes. They try to break out and then they come back down, and that kind of keeps things going as they are now until maybe next year. That would be my guess.
Michael, given the flow of funds data, what's your view on inflation, and what's your view particularly on whether we're in a bubble or not?
I think the answer is yes, very clearly we are. Yes, yes, and yes. I mean, to take one step backwards, in terms of how we look at things, across border we take, as Ian said, a flow of funds view. I originally worked at Salomon Brothers, where I had to unlearn all the macroeconomics I'd ever learned at university. People like Henry Kaufman, who were then in charge of Salomon's, effectively saw the world coming. If any of you are interested, just go on to Amazon and get some of his books. They're probably 50p now. They're sort of out of print or whatever. But this is phenomenal stuff. This is prescience 20 years ahead of what happened. And basically, it's all about capital flows in history. What you've got to look at is to see how the world works. The most important price in the world economy is the price of the dominant economy's debt. So coming into this year, what you had was radical overvaluation of the major safe asset in the world economy, US dollar and the US Treasury market, both 20% or more overvalued. What we're seeing now is that correction. In the future, what matters for asset allocation are those two questions. What is the dominant economy? I'm afraid it's no longer the US, it's China. And what is the price of the dominant economy's debt? What we're seeing is an adjustment underway. For the last 3 to 4 years, something like $3 trillion of capital, thanks very much Mr. Draghi and thanks Xi Jinping, moved from China and the Eurozone respectively into the US, bloating the value of US assets. That's what the US bubble's been all about. It's now starting to migrate out. And what you're seeing in the world economy are two very interesting policy responses. In Asia, where they're receiving dollars, they are monetizing those capital outflows. So what you're seeing is the US bubble transferring to Asia. That's going to go on for some months yet. In Europe, what's happening is that they're not monetizing, they're letting their currency value go up. And that's the question. The interesting one to dwell on, which I can come back to, is what is Japan doing? And that's a big geopolitical question.
We have a fairly more sanguine view about the bear market and bonds. We think cyclically bonds are expensive, and you're going to see a backup in yields. I'm not sure it's a secular bear market in fixed income. Equities, yes, things are close to bubble territory, but I think your standards of judging bubbles have shifted quite a lot in a low macro volatility, low inflation, low real discount rate world. So if you look at Shiller's cyclically adjusted PEs, they haven't really reverted to its 120-year averages in the last 25 years. They've actually, the average has been materially higher than what the 120-year average would suggest. So I think as long as we remain in a low trend growth, low discount rate world, inflation risks are likely to stay contained. What's quite significantly different from the 1950s and 60s to my mind is that the demographic backdrop is very different. If you look at the link between demographic and average inflation rates across a cross-section of countries and across over time, it's a very stable relationship. Aging societies are low inflation societies. Younger societies are high inflation societies. You don't have many young societies in today's world. We've got some fantastic research coming out on the macro side, which actually explores this dynamic in great detail. But if you look at the average growth in labor US workforce, and if you look at the performance of inflation 3 years later, they seem to line on top of each other. And I'm afraid labor forces in major economies are likely to shrink, not rise. So I think demographics is a huge challenge to a breakout from the low inflation environment we're in. What's the implication for that of that for asset allocation? Well, a low discount rate world is likely to stay with us. I agree that, yes, the dollar was quite expensive. US Treasury yields were way too low. I would say European yields are even lower. I would agree with members of the previous panel who expressed concerns about gilt markets. But I think it's more of a cyclical story. I think we are likely to stay persistently in this regime where real and nominal discount rates stabilize around materially lower averages, simply because of the structural backdrop we have currently.
And Eric, I mean, the same question to you, but maybe just putting a little bit more of a UK spin on it. The UK seems to have the inflation which may be coming, at least in a cyclical sense, in the United States.
Yeah, I think it's much more actually a US story. If you'll forgive me, I'm going to stick on the global thing. We can come to the UK in a bit. Are we in a bubble globally? Yes, absolutely. In our judgment, in equities, yes. In bonds, yes. Globally, in housing, almost, and other asset prices too have been absolutely bloated and remain that way now. And where we are now in policy terms, the way we're characterising it in our current forecast is the dawning of a new era. We're in the process of making another policy era of a similar sort to the one that in hindsight I reckon we all judge was in place in the 10 years ahead of the financial crisis. We're on the brink of doing that again now. We're in a global developed economies that are at or above capacity in our judgment, and on massively supportive monetary and fiscal policy already in place, about to double down, particularly in the US, which is going to create a huge cycle for the next 2 or 3 years. 2020, 2021, we have getting on for a 50% chance of a global recession occurring at that horizon, driven by spiking long rates, which was discussed in the last session, particularly corporate bond rates, particularly in the US, hitting highly geared corporate sector in the US. The gearing of the corporate sector in the US has changed materially over the last several years, so that the thing that I grew up as an economist learning, which was in Europe, corporates finance themselves out of debt, and in the US they finance themselves out of equity, is no longer true. The gearing of the US corporate sector is now ahead of that in Europe. And so it's particularly sensitive to a rise in the long end of the yield curve and a widening of corporate bond spreads, which is what we anticipate as a result of this policy error that's about to be made over the next couple of years.
Okay, I'd just like to take this, which has essentially been tactical stroke cyclical asset allocation, try and push through what the implications are of this for strategic allocation. If you go back and you have a look at the secular waves in the bond market, there have been about 5 of them since the American Civil War. They tend to be 30, 40 years, much longer than in terms of equity markets. Most people seem to put the emphasis in terms of saying this is a cyclical outbreak in inflation. Is anybody here sort of who believes that there's something more than a cyclical outbreak in inflation going on here, that we're maybe having a secular pickup in inflation, and that's got to bring the secular bull market in bonds, which began back in 1982, to an end? Or perhaps the other question is, has it already ended? Tim?
Well, yeah, I think that's implicit in saying that bonds are entering a secular bear market, is that inflation will enter a more of a secular advance here. Of course, at first it'll be cyclical, and then what we'll see is you go to a higher, go to initial high, come back down, we'll get a recession, bring the inflation down, then back up it goes. And so if in fact we're going to enter a secular bull in bonds, then we would expect that to be consistent with inflation expectations. And that's also why we feel that commodities and gold is something that nobody's really talking about gold here, but gold appears to have started a long-term uptrend consistent with the dollar moving into a long-term downtrend. And the dollar has a real problem. I agree with the point that the dollar had been overvalued. It still is on the basis of purchasing power parity, even after all this weakness we've seen. And this is a real shift. I think what we're seeing here is the dollar status as a reserve currency is in question, and we may, I think the main thing to keep in mind about the U.S. as well is the deficits here. That's a really negative. We're going to go to record high deficits. That's very dollar negative, and that ultimately will be good for gold. But I think it's also what we're seeing in the U.S. It's going to take a while, given that it's not global yet. But we're seeing fiscal monetary stimulus and the dollar weakness, which is all really a lethal combination when it comes to inflationary pressures.
So. If you'd asked the question 15 years ago, you're going to have a budget deficit which is going to go to 5.5% of GDP, and monetary policy is going to be tightening. You would have expected this happened in the early 1980s for the dollar to be going through the roof. Why isn't that happening?
Well, because again, it's the focus right now, and we focused on this quite a bit this year. Is why have interest rate differentials not helped the dollar? Well, what it is, if you look at the correlation between interest rate differentials and the currencies, there's really no correlation. If you look at economic differentials, for example, take a spread. If you take the weights in the dollar index and then apply that to industrial production and compare it, the U.S. industrial production to global industrial production, we see is that correlation is very strong. So that the currency markets are really keying off of economic expectations. And the fact is the U.S. started early, so that helped the dollar in 2014. But since then, now we're the U.S. is getting more mature on top of the deficits, which are going to be a big problem. And I think that's why the rest of the world haven't come around strongly with economic momentum. That's what the currency markets have been focused on. And the other point I'd make, you mentioned Europe. We should also think about correlations. That when the dollar weakens, that's very good for emerging markets. When the euro strengthens, that's very bad for Europe. The pound also, pound strength is bad for the UK. We see this in the relationships between the markets. So.
If I could just add a point about the dollar. I think
sure.
There's no stable association between pro-cyclical fiscal policy and monetary tightening happening together and the dollar strengthening. So the only instance of that happening in recent memory, I think, was the Reagan years, when there was policy tightening and there was pro-cyclical fiscal expansion. The Bush years saw the same thing. There was tax cuts and Fed policy normalization. The dollar actually weakened through that cycle. In the late 1960s and 1970s, you have smaller, shorter instances of that combination, and actually the dollar weakened. I think the initial conditions are very important here. The dollar starting from levels of very expensive valuations. And I think that it really is, and the fundamental backdrop is very different. I think inflation expectations are very well contained as compared to the 1980s when they were very, very unanchored. Inflation volatility was high, and inflation expected. The policy framework was not particularly predictable. I think the previous panel, there was a lot of complaints about policy making today, how there's been a loss of credibility. But I would say policy is more transparent now than it has ever been in the last 35 years. And that has, in a way, helped stabilize inflation expectations. If you look at the wage pass-through to core inflation, that's diminished. If you look at the correlation between wage growth and core inflation in the United States, that's gone to zero in the last 20 years.
I'd like to pick you on something you said policy is more transparent now. Maybe Eric and Michael can comment on this. But given China's increased importance in the global economy, I would say that policy in China is opaque, and that creates a problem in its own right. How do you feel about that, Eric?
Absolutely. The definition of opaque. Look up opaque in the dictionary, you'll find Chinese policymaking. Absolutely, and China is, as you rightly identify, a bigger, more important part of the economy, obviously, globally. Actually, I dispute something that was said earlier, I can't remember by whom, about I think it was you, about the role of China as becoming the dominant economy in terms of capital flows and that kind of thing. And there are some respects in which that's true, but there are other important respects. There was a question raised in the previous session about the status of the dollar as the reserve currency and all of that. And I think we are, in our judgment, a long, long way away from that. China realistically usurping the dollar as the reserve currency. In the last time there was a switch over from sterling to the dollar, the US became the world's largest economy some 30 or 40 years before it became the reserve currency. And it takes that long for those things to budge. Vast majority of foreign of official reserves are held in dollars compared to renminbi still. And there's a long way to go before that happens.
It may never happen.
It may never happen.
Because the US had similar institutions
Right.
to the UK, rule of law, courts, which China not necessarily
correct. And it depends on your outlook for growth in the Chinese economy. It was said earlier by somebody, I can't remember whom, that the growth in prospect, China can keep going. I think it was Charles in the previous session, can keep going at 6s. As far as the eye can see, I don't buy that story at all. I think it's going to slow much more rapidly than that. It's going to be much more like a Japan-style story. Huge build-up of credit and debt in China, rippling through the shadow banking industry that's ultimately going to become a contingent liability on the state, just as it was in Japan. And the consequence of that whole process of unraveling those non-performing bad assets in the banks and shadow banks is one that will deliver China into a much lower growth environment, like 2%. No further catch-up from here after the next 2 or 3 years. No.
Michael, a few nods, but a few shakes of the head as well. Your views, sir?
Well, I mean, with all due respect, I think it's just wrong. China very clearly has stated what it's doing. I mean, it's transparent. I've got to say that for it. What China's goal is displace the role of the American dollar in Asia. It wants to push the US out. The whole initiative that has been planned for the last 5 years, the Belt and Road Initiative, is well underway. And we just go out there and look. It's there. It's obvious, tangible, palpable changes going on. And basically, China is trying to effectively roll out its infrastructure boom across Central Asia. That's where it sees the opportunity. Look at some of these economies. Look at what's happening in Yunnan province in China. It's booming. Why? Because that's the next step on the Belt and Road. Vietnam is next in sight. They're going to start to develop this region very intensively. Which currency are they going to use? Okay, good luck if it's the dollar, because it won't be. It's going to be the Chinese yuan. And that's what they're trying to develop, a seigniorage system, which is how every great power establishes its presence. And that's what China's doing very simply. I don't believe China's a bubble. I don't believe it's going to crash. I think that the debt problems are way overblown by Western commentators. If you look at a parallel, look at what happened to I draw this one out, the Soviet economy. If you look at the Soviet Union economy in the 1950s and 1960s, people were saying exactly the same things about what would happen to the Soviet Union. By 1980, if I remember, people were projecting in the US, in 1972, people were projecting in the US that the Soviet economy would overtake the US. That was how strong it was. And the reason was essentially understanding how the economy is working. And what the Chinese are doing is they are not switching into consumer spending, which is what every Western commentator recommends. They're rolling out the infrastructure boom because they know that works. So effectively, I'm very bullish on China. I believe that the yuan is going to take over, and I think that the world is being shaped increasingly by geopolitics and a lot less by macroeconomics. And just as one, well, actually, I shouldn't puff somebody else, but I saw about a month ago what I thought was the most interesting independent research company that I came across when we were advising an oil trading company. And this was a company called Ron Advisors. I just don't know where they get the name from, but anyway, Ron Advisors. And basically, it's geopolitical risk that comes out of military intelligence. So it comes out of the Ministry of Defense here. It's former MI6 and GCHQ operatives, and they really knew their stuff. I mean, I was, taken aback. So if the investment banks think that they can compete in this space now, there's a lot more competition coming. And this is the way the world is moving.
I just make a point about the yuan's role. I would agree that trade finance-wise, the yuan's role is likely to grow quite exponentially. It's quite inevitable. I don't think that makes China a credible candidate for displacing the dollar as the major reserve currency, simply because it's not going to be the predominant form of funding in global markets. It's likely to stay a dollar-funded world simply because of, and this was Iswa Prasad, the academic who's worked a lot in China. This has made he point that you need a set of institutions for a currency to become widely adopted as a major funding currency. So it's not just the People's Bank of China. It's also capital flows, open capital account. Courts being able to arbitrate disputes, for things like settlement of contracts. And I think currently, at this point in time, it's not entirely conceivable with Mr. Xi becoming a perma president that sort of institutional transformation is likely to come to pass. So I totally agree with you. I think in terms of trade finance, the yuan's role is likely to rise massively. I'm not sure it becomes the dominant funding currency. I still think in 20 years' time, the dollar will still be the dominant funding currency of the world.
Okay, so this is very interesting, but just to start at the asset class level now. We've talked about China and we've talked about the US, and arguably those are the only two things which really matter. Europe is a residual of that. Sorry, I live in North America, so I can say that with some degree of impunity. But give you all a hypothetical portfolio of 60% equities and 40% bonds. Given what's going on in China, given what's going on in the United States, given where we are in the cycle, and given where we are in terms of valuations, how would you allocate?
Well, what we're recommending right now is overweight equities. So the way we do it is on a global balanced account portfolio with a benchmark of 55% stocks, 35% bonds, and 10% cash. We're recommending 65% equities, 30% bonds, and 5% cash. And that's been our allocation for the past year, and I would say we stay with that. Stay overweight equities from an asset class standpoint. Within regions, we've been overweight emerging markets since early last year. Actually since 2016, and I would stay with that. That implies, given the weight that China has, the EM index, more than 25% of the weight, that implies being overweight China. So stay with EM, that's been our major call. Underweight Europe, underweight the UK. I would say...
We'll pick those up later, so just focus on the asset class now. Michael, the same thing on the asset class.
I think in terms of broad things, I would say overweight fixed income. Very significantly. If you can't make money out of fixed income in this environment, I mean, you must be doing the wrong thing. If yields are going up, there's some fantastic opportunities out there in fixed income, and I think the yields are going up. Equities underweight, particularly developed markets, particularly Europe and the US. Currencies overweight the euro. Emerging markets, I agree with Sam, absolutely, and a very high exposure to China. Need to say, you expect me to say that?
Yeah, overweight equities, I would say. I'm not sure how fixed income makes money if yields rise, but I would have thought that would be mark-to-market losses. So, yeah, overweight equities within that, emerging markets, increasingly more, but also staying with the United States. I think there's a number of factors which will...
Would you be buying on dips as well?
Yes, we have been, and I think this has got further to go. Is it rational? I think your point number 6, are we all overconfident? No, God, no. We are scared. We're scared of missing out, and that's why. And I think there's a number of factors why, that there's a good chance why a lot of people worry about missing out. It's not just momentum. I think there's a number of underlying factors which are at play. I'm conscious you just wanted asset class views, so I just wanted to say overweight equities, underweight, say, fixed income. That's
Eric, are you going to go with the majority view now, so to go overweight equities? Or
No, I'm not. So I'm scared about the fear of missing out. It's a weird one, huh? I saw that reported somewhere else that's a mood in equity markets. You're fearful of missing out on the next uptick and da-da-da. I think in expectation for the coming year, it depends massively on your horizon. If we're talking about a year ahead, for example, we're thinking of small positive returns in equity markets globally, but with massive volatility around it. This is not news. Everybody knows this story. Huh? If you're interested in returns like 4%, 5% on the year, and you can live with a large amount of volatility, then it's okay to be holding equities, but I wouldn't be overweight of them. And the reason I wouldn't is because underneath that, our judgment is equities in the round are overvalued to the tune of about 40%. And that will eventually come to pass. I'm not saying it'll happen this year. It may not happen next year. If we're right about the recession in 2020, then it'll probably happen then. I would certainly not be in China, or I'd be out of China. You're going to have to try hard to find places. If I think equities are overvalued, and I also think bond yields are about to rise, therefore bond prices are going to fall, I think bonds are overvalued too. Where do you go? It's a difficult world, very difficult one. You're looking for diversification in that world. You're looking for maybe real assets if you can live with the liquidity costs associated with that. You're looking for maybe individual countries that might do well in that mix. India we like, for example, continue to like India for the next few years. But there are risks attending all of these things.
It's okay to do nothing now and again. You know, it's the old story about the goalkeeper. You know, he's facing a penalty. He dives left, he dives right, 50% of the time. But sometimes the ball goes down the middle. It's called action bias.
Right.
So maybe that's where well, I hope technology is actually going to stay with us now. But in the armrest of the chair, you have a piece of equipment which is going to enable you to answer this question and see if you disagree with the panel or not. And it's quite simply, and I think we should rethink, will Treasury bond yields be higher, let's take the 10-year as an example, or lower in 3 or 12 months? So if you can vote on that, and hopefully the technology will actually produce a result. So those people up in the box there, I hope you're hearing me. Let's just see if it works. It's not working?
Let's do it by,
It's not intuitive technology.
let's do it by show of hands.
Yes, push number 1 or number 2. If this technology doesn't work, somebody else put me up to this.
I don't understand what the question is. There's 2 responses there, and is the top one higher or lower? Is the bottom one higher? I don't. But anyway.
Trick question.
Okay, let's do this the old-fashioned way. Okay. So, can you just take a show of hands? Those of you who think that bond yields will be higher in 3 months than they are today, and those who think will be lower than 3 months today. Right. And then in 12 months' time?
This is higher, is it? Higher.
And in 3 months' time? Okay, so I mean, so everybody expect bond yields to go up. I suspect. Let me ask the next question in terms of in 12 months' time, how many people in the audience actually think that equities will have beaten bonds over that period of time? So how many people think equities will have beaten bonds over that period of time? And in reverse, bonds beating equities? Right, so the cash levels, which are pretty low in terms of the flow of funds analysis, should imply that kind of cash levels are going to rise if the audience is right. And I think I'm right in sort of saying the consensus of the panel was, well, there were 2 in the positive camp and 2 in the negative camp, and and therefore things probably are going to remain more or less unchanged, right?
I guess it's a horizon question, so some of us, like myself, I think 3 months they could pull back a little bit, but over 12 months they're likely to be higher and stay.
Okay.
Yeah.
So let's sort of, clearly we've kind of, there's a difference between the audience and the panel in terms of the view on the equity markets, but if we were to take this down to a geographical level, obviously emerging markets had a storming year last year, largely on the flow of funds analysis. My analysis of emerging markets is always you're either risk on, risk off. The domestic fundamentals don't matter if you're in a risk on environment. You can make this distinction between the commodity producers and the commodity importers, and that works pretty well, but the individual country breakdown tends to get obscured. So can the inflows into emerging markets continue for another year? Michael, I'll start with you, but you seem to imply, given a very bullish view on China, that might well be the case, that those fund flows are going to continue in that direction.
Yeah, I think they will. I mean, I think there are sort of two heads up there. I mean, one is that if you look at what drives the cycle of capital flow into emerging markets, it's no longer US monetary policy, it's China. If you look at how that capital flow cycle evolves or has evolved in the last 10 years, it's moved very, very closely with the Chinese liquidity cycle. So effectively, when the PBOC eases, which is easing now, and has been easing consistently since the beginning of 2016, a lot of money has migrated into capital flows have gone to emerging markets. If you look at the complexion of those capital flows, and we monitor these things in great detail, the major source is actually not British, American, or European fund managers, investing their money. They tend to be later in the cycle. The early money in emerging market capital flows tends to be sort of local money that is held offshore. So, for example, the first indications we saw that emerging markets were starting to get more traction was about the middle of 2015, when we saw a lot of Russian money from oligarchs, presumably, going back into Russia relatively soon after the sanctions were put on. And this is big. These are big amounts. And then we saw a very similar pattern evolving in Brazil. A lot of money coming offshore, converting out of dollars, going back into real, and that is the smart money. So that money is still there to go in. In terms of the bigger picture, all I'd say is that since 2010, more money has come out of emerging markets than has gone in. That's all you need to know. There'll be a lot more. People will chase growth. That's where the growth in the world economy is.
Tim.
Yeah, I would agree with all that. I would also point out that I think, and I have a panel later on the sectors, but I think we need to think about the exposure of different regions and different markets to different sectors. And if you go back to the beginning of the secular bull market in 2009, go back to the beginning of the cyclical bull market in 2011, what has been the strongest sector? It's been technology. What regions are most exposed to technology? Well, there's two, in our 7-way framework, there's 2 regions where technology has the most weight. One is the US, and the other is emerging markets, specifically China. If you take the top 10 stocks, Tencent and Alibaba, plus the FANG stocks, dominate. And this is going to continue. So I really think a lot of it has to do with technology. And one of the things I'm watching is, and I would say on both of those questions, overweight equities for 3 months, also 12 months, but 2019 could be when, as I said earlier, we reach sort of a cyclical turning point. Maybe by then you have 2 potential developments. One is, by that point in time, interest rates start to become a bigger factor. The current positive correlation between equities and yields, which is a key point. We haven't talked about it here, but that is still the case. As much as people talked about bond yields rising as being sort of the reason why the market sold off, it really wasn't bond yields. Market came down, bond yields kept going. That will change eventually. That's one aspect of it. The other one is what I call an earnings-driven retreat, where we get into an earnings season and a few of these big tech stocks in the US or China start to disappoint. And that could drive us into a cyclical bear, in which case the US and China would underperform given their weights on China, given their weights with technology. So I keep that in mind. And also when we think about Europe, very, very low exposure to technology. Same thing with the UK market, which actually has a higher resource orientation. So we really have to think about sort of the weights. So how are these different regions and markets composed in terms of the exposure to different sectors?
Sure.
Yeah, in terms of emerging markets, I would agree. Yes, it's right for another year of inflows. my consideration of drivers is very different, actually. I think the predominant driver here is the US dollar. I don't think US yields matter that much. You saw emerging markets rally through the backup in yields in the last couple of months. And the predominant correlation between emerging markets and core yields has not been the taper tantrum experience. Those are actually few and far between. The predominant experience is emerging markets doing well, US yields higher. I think the key driver here is US dollar. US dollar funding by some distance is the most important driver of not just capital flows cross-border, but also trade. And I think the impact of US dollar on global growth through the World Trade Channel is quite meaningfully less well understood than the impact through the cross-border funding channel. I think world trade is likely to get a major boost that benefits emerging markets. So I think, yes, there are differentiations to be made along sectoral dimensions, but I would say emerging markets exposed to world trade are likely to do quite well in an environment of weak US dollar. That I think is the predominant driver.
Eric, your view on this, and I'd just like to come back to Michael and after that as well, because you're interesting. You have an underweight position in equities, but you're bullish in emerging markets, and that's quite atypical because normally when equity markets are not doing well, emerging markets are high beta play on the downside. But Eric, maybe I can ask you that question, and Michael pick that up.
Well, I can't answer for Michael's views on the balanced portfolio, but
Well, I'd like maybe you can comment on his view.
Okay. So repeat it.
Well, he's bearish on equities,
right,
but he's bullish on emerging markets,
right,
and that pattern normally doesn't fit very well together.
Yeah. So okay, how can one make sense of that? I would share your bullishness in the short term on emerging markets in general. I think emerging markets do well in a risk-on environment in a world where global growth, particularly global economies, is doing well, which it is right now and will do for the next couple of years. That will support emerging markets for me right now. But and modestly support equities too. I wouldn't be, as I said before, arguing for overweight on equities. So I think I'll share some of your positioning there. I like emerging markets. I don't particularly like equities globally because there are massive risks attending that for me right now. The key thing on the dollar side, though, which a point of the story you were telling about the dollar, for me is this risk-on story, that we're in a risk-on environment. It's not just about the fundamental characteristics of the dollar as an asset, it's about the appetite of the market for risk at the current point in time. At the moment, the market is in a risk-on mood as we judge it, and the consequence of that is weak dollar and strength in other currencies. And it's helpful also for emerging market equities.
Michael. I think in terms of sort of asset allocation, maybe the bigger picture, I agree 100%. The most important thing is thinking about which currency you're going to hold your wealth in. And on that score, the US dollar is clearly in focus. What's going to happen to the dollar? And I think that my concerns are that we come from a position where we've been very negative on the dollar, and I think tactically one would have to argue that after this sort of sell-off, maybe there's grounds for the dollar rebounding a little bit. I think my deeper concerns are this issue about what the big reserve managers are doing. So if you start to look at data, for example, those of you that know the IMF COFAS database, which is the composition of foreign exchange reserves, dollar is about 62% of total forex reserves now. This is quarterly data that the IMF publishes, but it's on a secular decline. And I think, like most economic time series, the thing that we've got to be concerned about is there a tipping point at any stage? Does it cascade down and people start to lose confidence in the US currency? And I think that's an interesting point. Now, it's an interesting point for the perspective that I think America is using the dollar, or is thinking of using the dollar, perhaps to say, more and more as a weapon in this geopolitical game. And it's been alluded to by both the Treasury Secretary and by Trump that broadly they would like, in some sense, a weaker dollar. The question is how weak and what happens. Now, I think the thing is that they clearly have got Asia in their sights, but the thing is they don't really control the Asian currencies, the Asians do. The most significant development that I've probably seen in 20 years of looking at these markets is what the yen is doing. And the yen is the, if you like, the Sherlock Holmes story about the sort of so-called dog that didn't bark. That was the yen last year. The yen hasn't really moved when the dollar's been weak, and that's really strange. I've never seen that before. And if you look at what's happening in terms of Bank of Japan policy, they are very clearly changing how they're operating in the markets. And for much of the last 20 years, the Japanese have been targeting liquidity in the markets. We could debate whether they've been targeting it too high or too low. Probably it's too low. They are now seemingly targeting the yen. And if you look at the yen against a basket of its peers, it has been unbelievably stable for 18 months. And that is the key thing to think about. Why is that the case? Because if you go back 20, 30 years, what you saw was that effectively Japan was the whipping boy of America. And what you saw was radical over and undervaluation of the yen. You could not experience in a European country 50% overvaluation of a currency and 50% undervaluation within a 10-year time frame. And that's what Japan went through. And it was a wrenching change for the economy, as we know looking back. If you get that now operating in Europe and the Eurozone on the Euro Deutschmark, Eurozone is toast, or the European Union is toast. That's what's going to break it up. And that may be what the Americans are trying to do. Currencies are going to be critical. So what I would look at very closely is the dollar. And the interesting point is the yen may be a lot more stable against the dollar than ever anyone's thinking. If that is the case, put your assets in Japan, because Japan will be booming like other Asian economies traditionally do in a liquidity boom.
Okay, let's just pick some of those points up a bit. So first of all, just in terms of the audience view on emerging markets, how many people are actually bullish on emerging markets this year relative to other equity markets? A show of hands, please. And those who are bearish, well, the bulls definitely have it there. So if that's reflective of the flow of funds, and we're walking the walk and talking the talk as well simultaneously, then clearly emerging markets are a no-brainer. But Michael, let me just pick you up on that, and maybe sort of when we talk about asset allocation, Japan is normally sort of ignored. Just to extend your analysis a little bit further, I know what you're going to say in terms of what the implications are of that for Japanese equities.
Well, I mean, I think they're hugely bullish for Japanese equities, and I think they're very bearish for Japanese bonds. But I think the rationale, I mean, what's behind this, and I was sort of starting to think, I alluded to this geopolitical risk lot these people run, and they were talking very extensively about the change in American attitudes towards Japan that had evolved very, very recently this year. And they were saying that whereas Trump had sort of forgotten about Japan, suddenly with this sort of pushback on China, they realized that Japan is very important. So if they want to engage with the region, they've got to have an ally, an economically strong ally. And basically, US policy is starting to gravitate more thinking about the currency background and actually integrating Japan more into, or economically aligning with the US and making it a strong economy. Now, if that's the case, that clearly is going to be very, very important for the Japanese economy and the Japanese stock market. If you read, and for my sins I have to labour through this, reading Bank of Japan white papers, the Bank of Japan white papers for the last 5 years have been talking very explicitly about not having a strong yen policy. They've said what we need to do, in fact, is have a weak yen policy. And the reason being is that Japan is no longer a consumer goods exporter to America and Europe. It's now effectively, de facto, an intermediate goods supplier into Chinese supply chains. And therefore, they need competitive yen. So a strong yen, it would finish the Japanese economy off, and it would basically give China a free ride. So I think there is a big move going on here, at least in my view. I mean, clearly I'm maybe completely wrong here. But if that's the case, Japanese equities look sensationally good.
You're dying to get in there. Go for it.
I think that on Japanese equities, I would support the view. I just have a slightly different set of factors. It's simply profitability has risen to all-time highs. The Japanese private sector has stopped shrinking for the first time in 25 to 30 years. Underlying deflationary momentum has eased. For the first time last year in 2017, domestic demand, consumption spending and investment spending contributed more to growth than it had done at any time in the previous 6, and against the backdrop of no fresh stimulus. I think that says that there's a modicum of structural change underway in Japan. It's getting more interesting than it has been, and it's not a pure yen play. I would agree the yen staying low helps, but if you look at the performance sector level, which I'm sure Tim would know about, Cyclicals contributed more to the performance of Topex last year than they had done at any time since the advent of Abenomics. Previously, it was utilities, your dividend yielders. Last year, it was your cyclicals. And I think that could be symptomatic of some material change in the underlying dynamics.
Eric, Japanese Renaissance.
Yeah, so I like Japan in the short term. I fear, though, that this is another one, this is our take on it, in the sort of sawtooth pattern for Japan over the last 25, 30 years. There have been a number of cyclical upswings in Japan, rallies in the value of the currency, rallies in the value of the Nikkei, for a variety of different reasons, which have subsequently gone away as the underlying macro picture turns out not to have changed. The number of times we've been hopeful and tried to jump on that, are they finally out and home free and away from that rather disappointing growth environment they've been in for the last 25, 30 years? I'm afraid we don't believe they are, and the reason we don't is the same reason that affects developed economies globally. We don't think the current growth cycle that we're in across the developed world at the moment, which is very strong, will persist into the medium long term. And the reason is all about debt, the build-up of debt, which has yet to be resolved in the West and in Japan and in China as well. And that's the underlying factor that's weighing down growth in the long term right across the major economies in the world, and Japan no less than the others.
Okay, so time is drawing on, so I guess it's now time to turn over to you, the audience, for any questions which you might have to throw at the end of the panelists. Yes, ma'am.
Yeah, hi. Hi. So I know this is a global asset allocation panel, yet it seems when we're speaking about emerging markets, we're only speaking about equities. I'm curious what your view is on emerging markets, fixed income specifically. Well, it could be fixed income, but also credit, sovereign as well as corporate.
I'm happy to have a go. I mean, I think pretty upbeat. I mean, the only question is what's the underlying base yield in the market doing? I guess it's rising, but you've got relatively low duration across this space. Credit risk should be going down generally in the region, and I think currency should be firm. So I think you've got all the ingredients of still pretty good returns. I mean, clearly there's been a great rally in that sector, so one ought not to get too carried away. But I think generally, I think you can make a lot of money out of fixed income in this environment. And as regards the question, well, okay, if yields go up, don't bonds fall? Yeah, but you've got a duration target. Think about that strategy. But if you do, you've got a decent carry coming through the whole time. I think fixed income looks good.
In the short term, I would agree with that. I think there's we're in a risk-on world, and that's helpful for risk assets such as emerging market debt. In the longer term, though, first of all, the base yield is going to yield, which is the US bond yield, is going to rise, and all others that rising tide will lift all yields, including emerging markets. And the risk-on environment that we're currently in will probably reverse. I'm talking about 2-3 years down the line, and it will play out the other way. But short term, yes, I agree with that.
I think in terms of local currency, that's quite an interesting environment. Real yields are quite high relative to the last 10 years compared to core markets in particular. Yield curves are quite steep in some markets like Brazil, which also have high real yields. And it's a weak dollar environment. As I was saying earlier, I think the dollar is the single most important variable, not just for EM, but also global liquidity. And as long as the US dollar remains soft and global growth remains firm, there's no liquidity accidents. Emerging markets are likely to stay in a good place. As it was being noted earlier, net flows have still been negative since 2010. There's meaningful catch-up to happen there, and there's a lot of spread compression that can occur. Okay. More local debt, less hard currency, I would say.
There are a few more questions, but you just said something about the dollar. Can I just have a quick show of hands? How many people think the dollar is going to appreciate this year? Wow, that's contrarian to the line, right? Everybody's really bearish the dollar. Okay. Yes, sir. The question over there. Oh, sorry. Okay, I'll take you next. You go first. I'll be with you in a second, sir.
Okay. Well, it looked like I was the only hand up on the two last questions here that you mentioned. So, from my perspective, let's assume that the dollar drops about another 3-5% from current levels, and then we get a rally. recovering about 50% of what we've seen the decline from January last year. And let's just assume this is a hypothesis for the moment. What does the panel believe the benchmark MSCI Emerging Market Index will do? Will it stay where it is? Will it go up? Or will it go down? Let's hear on that assumption for the dollar, please.
If the dollar falls, then the MSCI emerging markets will rise.
No, I'm talking about the dollar going up.
Up, okay.
Yes, it may drop about 5% from here, but then the rest of the year it goes up and it recovers 50% of what we've seen the decline from January.
Oh, fair
okay,
enough.
so it's going to be going up. What do you think the emerging market index will do?
I would look for a decline in MSCI EM in that environment. It's as simple as that. We can go to the very lengthy...
A decline?
Yeah.
And anybody else?
Yeah,
If it's a 15-20% rise in the dollar, that tightens liquidity conditions massively, widens our dollar cross-currency bases, makes offshore funding tighter, all sorts of issues. That's not a good environment for emerging markets.
Sorry, it's a matter of degree. What was the size of the dollar rise that you're talking about?
Well, what have we dropped in percentage terms since January last year so far?
About 10-ish.
About 10%?
Yeah, trade
And we
weighted.
go down maybe another 3-4%, let's say. So then we talk about a recovery for the dollar of about half of that.
So it's
Yeah.
6-7% type of territory.
Maybe a bit more, maybe.
Yeah.
So for me, that's not going to do it to squeeze out any return you might be getting in emerging market equities. If you were talking about 15%, then yeah, it's a different kettle of fish. But
Yeah,
6 or 7%.
I would think it'd probably be what would happen is it'd sort of be a market performer as long as equities remain in their uptrend, as long as we have these fundamentals remain bullish with the global economy and earnings growth. They would, come back in terms of outperformance, market performer, but I wouldn't expect underperformance. One of the things I'm looking for as well is that with the dollar is that, as I mentioned this earlier, with rate differentials, and I think we really should watch this because as we see global rates start to, the problem we've had is that with rates at such low levels, it hasn't really helped currencies at all, or any particular currency. But if you start to see rates rise, I think we might see the dollar move into more of a trading range, especially if treasuries start to separate more decisively from other yields, especially on a real yield basis. I mean, one of the problems right now is people say, why does the dollar do better? But real yields are still close to zero on a short-term basis. So you really need to see that rise. And then I think you'd see a trading range of the dollar, and maybe EM would be more of a market performer until we get to the point of the cycle where the stock market's going to go into a bear market.
So Tim, I guess you get worried about the dollar when they put Donald Trump's face on the dollar note.
Yeah, it'd be a big problem now.
Yes, sir. Question over there.
There was just one mention of real assets in the whole panel so far. So I asked the panel what their outlook is for real assets in developed markets next. Obviously, there is the liquidity issue, and there is that the holding period has to be longer term, right?
Right.
So we're talking 5 years rather than 1 or 2 years, which is what we generally talk about liquid assets.
Right, so that would be my concern about it. It might be, on the face of it, right, I mentioned them earlier, the environment we're in with very strong growth globally, inflation picking up, yields across the yield curve picking up likely. It's a good time on the face of it to buy real assets because they provide you with some protection against the inflation risk, which is definitely there in our judgment, but you pay the price in liquidity terms. And the liquidity premium is high. It's hard to get something that's where there's value in that, depending how much you're prepared to forego in terms of liquidity. And why should you be concerned about liquidity? Well, you should be concerned because of the duration that you're talking about. If this is an asset you have to hold for minimum 5 years, let's say, then in a 5-year horizon, in our judgment, we're going to be in a global recession. And I don't like real assets in that world either, or any other come to that.
Any other questions? Yes, sir. In the microphone there, please. Just in the centre here.
Thank you. We've had a golden age for, like your question, the 60-40 asset allocation and risk parity. And taking what you've said today about the valuation of asset classes and looking out over the very long run for, say, 10-year outlook for returns, and then the correlation between equities and bonds that we might see, and the challenge for asset owners in that return world and how to diversify. What do you see as the big changes coming to our industry?
I can take that. I mean, I think one concern that's been bandied about is that fact that bonds and stocks could lose in tandem for a very significant period of time in the way they did in the 1970s. I think diversification is unlikely to be threatened on that count. That sort of thing only happens when a raw discount rate shock occurs, when inflation is counter-cyclical, it arrives in a bad time. So fixed income loses, but also equities lose. I don't think we're going to be in that sort of environment over the next 10 years. I think there'll still be an element of diversification. I don't think we're entering a secular bear market in say, fixed income. I think it's a cyclical bear market which will coincide with higher equity valuations. They're expensive today. They're likely to get probably way more expensive before Eric's recession comes about in 2020-21. So diversification is likely to stay.
I dispute the use of Eric's recession. Let that not go down in history, sorry. Sorry.
History basically says that when you have a sector change in direction of the bond market, there is no place to hide. The drawdown in the year after you get that secular change, on average, in terms of the S&P, has been in excess of 20%. Okay, so that's something to think about. Are there any more questions? Yes, ma'am.
We are in a world, even though we have a really good upswing in global growth, etc., we're still, from 10 years ago, we're in a world that is starved of fixed income. Going forward, surely that has to have massive ramifications for just asset markets generally.
Huge, absolutely. I think the shortage of safe assets that Ricardo Caballero and some of the others have talked about, to me, is a shortage of stores of value. Even unsafe assets are in short supply, which is why the South African bonds don't sell off as aggressively on a zoom-up scandal as they would have done like 5 years ago. And I think this is symptomatic of the world we're in. We're in an excess-saving world, not just because emerging markets are saving too much, but also developed markets, owing to aging societies, will be saving too much. Those excess savings will be looking for a yield-bearing home. And those yield-bearing homes will typically be in fixed income markets, and this is likely to be a low inflation world, which is why I don't think a secular bear market in fixed income is unlikely. You're going to see a lot of cyclicality around depressed averages over a protracted period of time.
I'd agree with that. I think to get to a secular bear market in fixed income, you'd have to run into you've let the inflation genie out of the bottle once and for all. Really, you've really gone and done it. And it's possible that'll happen. It's possible a Trump fiscal splurge will do it. I don't think it's going to be big enough, though, in my judgment. I think it's a cyclical story.
But an excess savings will. But Michael's looking for a big boom in China, and China's been the excess savings provider. Are we too complacent about excess savings?
But Michael's story, as I understand it, is not one of Chinese consumption, huh? It's one of further investment down One Belt, One Road. And so
that savings investment gap change then?
Well, they're exporting their excess savings just in bigger quantities than they previously were and in a different direction.
I would say we underestimate the impact of demographics. Outside of sub-Saharan Africa and India, there's no part in the world where populations are not aging at different paces, and that is disinflationary structurally.
We have to wrap up now, and I'm sure there'll be opportunity to ask people questions in the coffee break, but I started off by the final sort of agenda item was, are we all overconfident? Now, in terms of the questions which came from the audience, answers that came from the audience, clearly in terms of equities and asset class, there's no overconfidence there, unless I misread the situation entirely. The overconfidence may be in emerging markets coming through. Everybody seems to be very interested in what's going on there. So I'd just like to ask each of the panelists in turn, very quickly, if they were to be wrong in terms of the views they've expressed today, why do they think they would be wrong? Tim.
Well, probably the one view I have pretty decisively is that the stock market is going to remain in a bull market probably for another year. Why would I be wrong? Well, let's say actually this backup in yields actually has staying power, and you start to see, one thing I've been watching here are the outflows from bond mutual funds. The point is also to the point about, you know, where people are going to go for fixed income. Well, what happened during the taper tantrum of 2013, people started losing money in their bond funds as bond yields rose, and they started to have capital losses, and they started bailing out of bond mutual funds, but bond ETFs now are vulnerable in a bond world that has very little liquidity. And we could start to see a massive outflow from bond funds, which could actually exaggerate the yield rise and actually create a panic environment that carries over into equities. This leads to a de-risking phase, and maybe that sets us up. That would then raise questions about earnings expectations. The market would then say, well, valuations aren't justified. And then you end up with really a traditional cyclical bear market, where the market has to come down sharply to much lower valuation levels to put in a bottom. That's where I could be wrong. You know, when would that happen? You know, we don't know. So that's the one thing I'm keeping an eye on right now.
Michael?
Well, I'd be wrong on all of it, probably will be, but I think the two areas, one is geopolitics. I mean, that's clearly the element now that none of us really properly understand. That is sort of a left field event, but it's clearly very important for asset allocation. And I think this lady's point here about savings flows and bonds. I mean, what you've got in the world economy is every year, I think the figure is something like, was it $35 trillion of new savings are coming through, which need a home. And the fixed income markets, people want duration. This is pension money. And where is it? Where do you get it? I mean, a lot of it's not necessarily a hunt for yield, it's a hunt for duration.
It's a store of value, basically.
Exactly.
Where you can park your cash.
Exactly.
Where could I be wrong? Some liquidity or credit market event, I would say. I'm not terribly worried, as Tim is, about discount rate effects, bond yields pushing stocks lower. I think credit market excesses reach the point where higher interest rates begin to buy debt serviceability becomes onerous. That leads, in response to some shock, a widening of credit spreads, and that becomes self-perpetuating. The other thing is a dollar liquidity shock, which is essentially what 2007 and 8 was also about. It was initially about credit market excesses unwinding, but also eventually, in the most acute phase, it became a dollar liquidity shock. And whatever gives rise to that, we don't know. By definition, that's a shock. It's an epsilon in your econometric equation. So, yeah, those are the two risks that I see over the next 12 to 18 months, I'd say.
Sir? Eric?
Where I'd be wrong is if the inflation that we're anticipating does not come through, and that may be for a number of reasons. It might be aging, as you were talking about, and it might be excess savings being exported from China around the world and bidding down inflationary pressure everywhere as it was ahead of the last recession. If that were to come to pass, if there is no inflation response, yields don't rise at the long end elsewhere, then what we're in for is a rerun of the period for me 04, 05, 06, 07. The recession doesn't happen in 2020, it happens in 2023, 24, and it's a big one. It's another financial crisis like we had in 08.
Okay. Ladies and gentlemen, just remember Miss Peters' law. If you're not confused today, you're just not thinking clearly. That's about all we have time for. Please give our panel a very warm appreciation. Thank you very much.
Well, thank you very much. While the panel leave the stage, I'll just quickly tell you what's happening next. So we're breaking for a coffee break, and then you have the first decision to make of the day, because there are then two sessions to choose from. One in here, which is a session I'm moderating on emerging markets. So if that's what turns you on, come back here after coffee. If, on the other hand, you want to go to the currencies session, it's in the Max Rain Auditorium, which is just opposite. Go through where the coffee is and on the other side. We are going to reconvene a little bit later than on the programme, so we'll reconvene at 11:20. So quick time for coffee and a chat, which will be served out here. See you after the break.